Hello and welcome everyone to Apollo, Hyper's startup community. My name is Sam Cust, director here at Hyper, and joining me today is Vadim Petrichenko of Blossom Capital Partners. Very excited to sit down with Vadim today and provide insights and helping you into raise funding from angel investors. Vadim himself is an active angel investor within Hyper's network, having backed Hyper startups in the past. And Vadim, wonderful to have you exclusively on Apollo today. I'll just get you to, there you go. You on, mate? Can you hear us?
Yeah, I'm on. Absolute
There we
pleasure.
go.
Thank you for having me on, mate. Can't wait to have a chat and, download any pearls of wisdom, if you want to call them that. But look, certainly love to support the ecosystem, love what you guys are doing. There's certainly quality coming through from the Hyper ecosystem as well as the broader startup ecosystem in Australia. So it's a great time to be excited about what's happening. Look, any questions from the group, fire them away. I'm happy to be as candid and open as you guys need me to be.
Yeah, fantastic. And really appreciate that, Vadim. And as Vadim mentioned, just from some housekeeping point of view, we've got the chat channel open. So any questions anyone has around angel investment, what you're looking for, anything will be as open as candid as possible. At the end of the day, we want to help you all get funded and get going. Just to kick us off, Vadim, for those that don't know you, keen to hear a bit about yourself.
Oh, look, absolutely. I've got a pretty boring background compared to some founders that I come across. Look, my background has pretty much been across various corporate roles, working with large ASX, multinational businesses, senior sort of management roles and developing capabilities and teams and all that sort of stuff. So a lot of the practical background for me has been around operational sort of procurement, commercial type roles. I could chew the ear off anyone that wants to talk about procurement and the good and the bad. But from an enterprise corporate level, that's kind of my background. And so because of that, I have a natural inclination toward enterprise SaaS, enterprise B2B sort of solutions within fintech, martech, ad tech, and any kind of business optimization and automation tools. My personal background, look, I did a bit of software engineering out of school at university, and then final year of that I realized this is not me, and ended up doing a business law degree. And so from that fell into procurement and supply chain purely by accident. A recruiter tapped me on the shoulder and said, "Oh, you've done some legal stuff. These guys do contracts." And I had to quickly Google what the hell is procurement. So look, I fell into it by accident, loved it, and just by the varied nature of what that allowed me to do and work across many parts of an organization, really developed a generalist skill set, very commercial sort of approach. And on the back of that, really got into working with suppliers, so working with businesses and understanding how they can solve pain points for various enterprises I've worked at. So that sort of entrepreneurial approach is very much ingrained in me, and that's why I've got a real soft spot for founders who are entrepreneurs doing it for themselves.
Yeah, great, Vadim. I appreciate that. And we find so many times that angel investors are often coming from being an expert within an industry. That's where the investment mandate might line up with that particular startup. So in terms of your journey, when did, I guess, angel investment first happen for you? What was your first investment and how long have you been investing for?
Oh, look, as an angel investor, active angel investor, I think maybe 4 or 5 years ago, I started doing it properly, and I always kind of tinkered with investing, and I've always been interested in it. Absolutely sucked at investing in shares and ASX. Just can't pick them, and it's quite a difficult thing to do for me anyway. But one thing I did refine a lot through my corporate career is that ability to kind of work with individuals and people to figure out problems to actual solutions to actual problems within enterprises. And so I kind of took that on and started working with a friend of mine who was running a startup maybe about 6 years ago or so, where they needed help appointing a marketing agency into their startup. They had no idea how to do it. They didn't know how to negotiate it, didn't know how to manage that agency once they came on board. And I kind of did that for them. And as part of that process, I was like, well, this is great because this is really helping grassroots sort of founders figure out what they need. And I've got the skill set from corporate, which while it's generalist, I actually have a lot of ability to draft and read legals, negotiate commercial outcomes, mediation, dispute, all that sort of stuff. So I fell into it, loved it ever since, and haven't really looked back. Look,
That's great.
not all of mine have been successful, but
well, time will tell, I guess. So 4 years investing as an angel. You know, how many do you think you've made? Is it 5 to 10, 10 to 15? Do you know the number?
My partner and I, we're doing this together now. Joanna Zaslavsky. So she's amazing, and she, her skill set's very much in that finance space and the relationships that she's got there. Between us, we've got about 26 direct investments, which is a great portfolio because, as you know, with this sort of stuff, you kind of need to spread your risk. We're not at that kind of massive angel level that you hear in the ecosystem that have hundreds and hundreds of investments. But look, we're certainly very particular with what we try and do, because personally, I'm what some people call operator angel, where I tend to get involved and support directly with some of the investments and founders where they need it. Happy to be indirect and happy to be passive, but certainly with some of them I'm more hands-on. A few of them now I'm working with in terms of how do we scale into new markets and growth, and others are more of an advisory around capital raising. Others I'm just kind of helping out with legal docs or anything like that. So that generalist skill set that I've got, I'm actually applying it to all these different founders in different ways.
Yeah, fantastic. That strategic investor, angel investor, certainly is something over the last few years I've seen personally with the startups we're involved in just happen more and more. And it makes so much sense. You know, not only someone investing their capital, but they're also investing their time and energy. So that strategic investment helps, increase the value of the business further than just the initial capital outlay as well. And we'll probably talk about that a bit further in terms of some strategies for people listening about how to actually appeal to a strategic investor, to actually, get them on board and want to be an advisor as well, to kind of, get them excited about that particular platform. So yeah, that's a really cool notion. I appreciate that, Vadim. But I want to talk about one particular investment to kick people off. So we reached out with each other about 4 years ago, I think it was. I think you were potentially looking at doing your own startup, and then you said that you're interested in investing. And I actually put a deal in front of you at the time. It just come through our Accelerate program or process, which is Empiraa. So I remember sending you over that email, having a look. Do you remember what drew you to that investment initially to have a chat in the first place?
Oh, look, I think it's credit to you for understanding the type of investor who would have been interested in that particular opportunity. So, as I said, because my background's more corporate enterprise, this particular one, and I'm actually just put the foundational T-shirt that I got out of it. Empiraa was a solution that really helps enterprise and businesses with their strategy and really streamline some of it and drive accountability. And it's certainly an issue and a pain point that I've seen firsthand. So again, just your ability, Sam, to identify the angels or the investors that will understand the problem and resonate with the potential solution. And granted, it was early on and there's lots of changes that have happened along the way. It was easier for me to get behind that because I understood what the opportunity is, but more importantly, I understood that the problem they're solving is one that hasn't been solved yet, certainly from personal experience. And that's great. One credit to you guys and the way that you're able to kind of take a founder's ideas and package them up in a way that's presentable then to someone else, but also at the same time really testing the founder to go, is this crap or is this actually good? Let's actually think about through how you would actually build a business out of this as opposed to a nice little idea.
Yeah, no, I appreciate that, Vadim. I certainly recall, from that point of view, I think you may have been even Ash's third or fourth investor that he spoke with. And the first couple, he really, almost blew it. And we had to do a bit of pitch training and really helping to refine that. And again, really learning. Really learning to understand, I guess, your investment mandate, as we spoke about. What's your background? What are you passionate about? And we find most of the angel investors that invest in any of the startups are ones that have that, I guess, aha moment. I've felt that problem before. I really have felt that problem before. And they're investing into something they believe in, which certainly helps, for sure.
And look, over the half a decade or so that we've been doing this, ours has certainly matured and changed and evolved in terms of how we pick the things that we pick. And initially, when you're starting out, obviously you're kind of gravitating toward the stuff that you know more about, because you're more nervous and a bit of risk averse. And as you start to get more and more into it, you start to understand the common themes that you look for. You know, and at the moment, for example, we're investing into a dentistry AI. Like, I don't come from healthcare, I don't come from dentistry, but the fundamentals of the business, and also kind of understanding what I'm looking for, that helps us actually get a lot more comfort around the investment.
So on that, what are you looking for? You know, what are the key factors that I guess founders should think about that they need to prepare themselves to come and talk to someone like you?
So look, first and foremost, we do look at more tech or tech-enabled startups, and they have to be local Australian startups. Look, for simply selfish reasons around personal tax and all that sort of management and administration, look, we want local startups, but also the local ecosystem we want to support and grow. So on both fronts, for that reason, we look at local techie sort of startups, but it has to be early stage. We don't look at later stage. So your pre-seed and your seed is our kind of sweet spot. Anything from just concept, which is rare, but from concept, like with this particular startup, we invested when it was just a bunch of wireframes that you guys had developed for them to show what it would look like once it's ready. But usually we want to work with founders that have been already proven or exited in the market. That's not a hard and fast rule, but it's certainly a preference, because being a founder is difficult, and it will be testing, and founders who have done it before will understand some of the challenges and the hurdles that they have to go through. So when you're working with subsequent time founders, it usually kind of is a preference for us as well. There needs to be some sort of market validation in the concept as well. So whether that's revenue generating or some sort of metrics to show that there's demand or market fit is absolutely key for us. And there's a lot of pre-revenue sort of validation metrics that are available, and happy to share it with anyone after the call if they needed to, and connect with me on LinkedIn. But that revenue customers willing to pay is fantastic, because that shows us, yep, you're onto something and there's people out there willing to pay for it. In terms of the market size, like for us, it has to be massive or scalable. It can't just be a niche concept. The reason we do that is because we want to see a return on the investment, and the only way you're going to get that investment is by having large attainable market that you could potentially get a market share of. We want to make sure that we're investing in stuff that we'd use ourselves. That's kind of the last little thing that we need. So if I'm willing to use it, if I'm willing to pay for it, that's kind of it's a massive step toward an investment from us.
Great, totally makes sense. And what, you know, that market validation piece that you spoke about, or trying to, I guess, demonstrate traction pre-revenue is certainly very important. And that's one thing we speak about during our Hyper Accelerate process, is being able to demonstrate traction through partnerships. So other ecosystem partners within the industry you might be playing in that provide you with some positive feedback. In the case of Empiraa, I recall Ash showing you that he had a wait list of, I think, about 40 or 50 companies that had garnered interest in wanting to use the product when built. I'm sure that would have been something that was enticing for you to see.
100%. Yeah, 100%. Because it showed me that I wasn't just the only crazy person that thought that was a good idea. There's some other crazy people out there that also said, hey, we need this. We think we could use it as well. Let's give it a crack. Let's once it's ready, give it to us to use. And for me, having a list of 40 businesses that are willing to do that, before you're even generating revenue, before you even have a product, just saying, hey, there's something here. That was a really nice thing for us to look at.
Yeah, great. So I imagine as well, when people are reaching out to you, they might just have an idea, maybe a pitch deck or something. You know, what's kind of your advice to those people? You've mentioned to go get something built, or not get something built, but actually go and show some further traction. Like, what are you seeing people actually coming to you with? Do they need to level up a bit more, or are they at the level? Like, what type of people are actually going from reaching out to having an actual conversation with you?
It's a mix. It's a mix because you've got people who are reaching out cold, which is absolutely fine. And then you've got people who are reaching out warm through network contacts and things like that. Look, obviously, we will naturally gravitate toward people who come to us through a warm referral. So certainly with Hyper, for example, if we know that we're getting a referral through Hyper because we know how connected Hyper is, we know the ecosystem position you guys have and the many people you know, that when you're referring something, there's a little bit of thought given to it, and it's considered as to why you're showing it to us. So we will look at those sort of things over others. Cold, it's harder for founders to reach out cold, and don't expect too much of a response rate, because we get a lot of these proposals sent to us, and we've only got a split second of attention to get from it. So the one thing I'd suggest is, look, my Calendly is open for people to book meetings with. But if you book a meeting with me without providing me with context or even a pitch deck, even separately on an email, I'm generally going to be less inclined to have that meeting, because I don't know what it's about and I'm looking at other things that are making more sense to me. So that's one. The other is the pitch decks. Look, obviously there's various ways you can structure them, and there's heaps of content out there around what constitutes the right pitch deck contents. I'm not too fussed about that sort of stuff, as long as it gets the key messages across in some way. But the one thing that's really difficult is when it's too many words. It's really hard to read, almost like a novel, or just too much text, because your attention is just on so many things at once. You're opening this expecting to get a really clean, crisp overview of what it is. And remember, your initial pitch deck that you send out to investors shouldn't be your entire pitch deck. It should be a teaser. It should get your points across succinctly, more visuals, really talking about what's the problem, what's the opportunity, what's the business model, who are the team, why is now the right time, all that sort of stuff, really basic stuff. I think StartMate had like a 10-page template. You're going to have resources all over the internet around how to structure this sort of stuff. It's really well documented by now. Don't overdo it on your first one.
Yeah.
Your subsequent conversations will allow you every opportunity to really dive into some of the more particulars about your business. You're passionate about your business. The founders are just head deep into this sort of stuff day in, day out. You need to put yourself out there and go, you're talking to someone for the first time about this and you're overloading them with content. Don't do it.
Yeah. That's really good advice. And one thing as well, Vadim, that I often see is people might say have a meeting with you and you choose not to invest purely because it's not within your mandate, or there may be a factor or reason that actually has nothing to do with whether the idea or whether the concept or the startup's going to work or not. And then that founder may give up, or they get a poor taste to want to go do it again. What we try to advise is, at the end of the day, though, you've got a network. So you may like this, but you may not be ready to invest. How many times have you had the case where you've actually referred it to someone else or someone else in your network to meet with someone?
Yeah. And absolutely right. Like, I've had times where I simply didn't invest because there was just a better opportunity come to me at the same time. So there's nothing necessarily wrong with it. It's just allocation of funds is limited, especially for individual investors. We don't invest other people's money. It's our money. So we prefer to put it into things where we feel naturally more excited about. If you approach it in the right way and you still make it easy for us to understand the investment that we're not going to back, it makes it that much easier for us to refer it. And I'll handball it to Sam and go, hey, Sam, check this out. This looks really cool. I just can't invest in it at the moment. Maybe someone and then you kind of, that network effect will start to grow. But if you make it really hard and it's confusing, it's convoluted, there's just way too much for us to understand on a page, we usually just park it.
Yeah, that's good advice. From a preparation point of view, can you tell when a founder has actually taken the time to understand your background, maybe tailor their pitch towards you? And have you seen that work and certainly not work when in conversations?
Look, I'm generally less fussed about that, so I don't take notice of it as much. But look, certainly if a founder's understanding the value that I can bring to them, because they can see that I've got the experience, or I've invested in some other startup that could potentially be complementary to their business model, like a partnership or anything like that, absolutely, that will get me to sit up, because all of a sudden one of my portfolio companies could benefit from this investment as well. And that whole idea around ecosystem, it also applies to your portfolio. Like if you could have complementary investments that could kind of support one another, but also if I am genuinely going to be helpful and be what you said before, a strategic investor, 100%. You know, I'll look into it a little bit more seriously. I'll lean into that opportunity more because I go, right, well, they're asking for me because I can actually help with something. It's not just dumb money that they're after.
Yeah.
I would rather be more of a hands-on investor than a passive one. Not to say that when there's an amazing opportunity, I'll just say take my money and go.
Yeah, yeah, and that's the advice that we have is we find it's better to ask for help, you know, from someone like yourself than just asking to invest, you know, to at least get that initial conversation and really draw you in to have, you know, I guess an intrinsic investment within
100%.
that startup.
100%. And look, one of the reasons that a syndicate, and this is kind of a bit of a segue into kind of what we're doing now, but one
Yeah.
of the reasons a syndicate is really helpful in that regard is because it's not just our brains that you're able to then get the benefit of. It's, you know, it's a group of 100+ investors that can actually look at this, and there'll be individuals there with the right experience, with the right connections, with the right sort of qualification or whatever that you need at that particular stage of your business when you're raising. And you know, we've had investments in the past through the syndicate where people have then separately joined the founder in an advisory capacity, whether it's an advisory board or just informal advisor, to actually help them with sales, with marketing, with operations, with just other capital raising sort of connections and things like that, but all because of the benefit of the group, the syndicate.
Yeah, great. And that is a great segue into Blossom Capital Partners, Vadim. So yeah, tell us a bit about Blossom.
Yeah, look, we started Blossom early last year, I want to say, and it came on the back of us investing in Aussie Angels. So Aussie Angels is an Australian platform that allows people to create syndicates and invest into startups as a syndicate. So instead of, for example, 100 people going onto your cap table as individual line items, you get the one line item, Blossom Capital Partners, go onto your cap table, but you've got all those individuals that form it as investors under that one, so it keeps your cap table nice and clean. But we started the syndicate for two reasons. One is we saw the opportunity to grow and support the ecosystem, open up the deals that we're seeing to more investors that want to get into the space, and we provide an on-ramp to early stage investors as well as some experienced investors. We also wanted to support our own investment into Aussie Angels. You know, if we're going to continue to invest ourselves, why not open up to other people to have a look at what we're investing in and give them the option to invest alongside us and co-invest? And so we've got high net worth individuals, we've got sophisticated investors in there, we've got family offices investors in there, some VCs. So it's a good mix of investors within the syndicate that will get to see every deal that we look at and choose whether or not to go in with us.
Yeah, cool. And I think we mentioned offline there was another hyper startup that you'd maybe spoken to through Blossom in Wavy. That came about.
Wavy. So Wavy reached out after they'd gone through the hyper early process, and they had some of their business model developed, some wireframes developed, and it looked really interesting. So for that particular one, we didn't go ahead at that particular stage for various reasons, but kept in touch, and they ended up subsequently doing a raise through successful crowdfunding campaign. But we're watching that one with interest just to see how well they can move on and demonstrate market fit. So from that point of view, that's one of those examples where I don't know too much about real estate. And for me, it was a bit of a passive interest because I just wanted to see how much traction had been established and how much market validation had been done. And in the end, I just felt like there just wasn't enough for me to be comfortable jumping in at that early stage, but it's something I want to do later, as opposed to Empiraa, where I came from that space and I understood the problem more, so I leaned into that a lot more comfortably.
Yeah, makes
sense. And I guess that's the key for anyone. Look, I know it's hard, because you don't know everyone's backgrounds and all investors' backgrounds. But if you can find a way to find those investors that have an understanding of your space, your industry, whatever it is, those will probably be more fruitful for you than just the random generic sort of outreach.
Yeah, that's great advice. And that's what we aim to do here at Hyper, is really understand that mandate and make that marriage as swift as possible. Vadim, regarding, I guess, yourself and as well with Blossom, what, I guess, kind of check size, as low or as high do you guys typically go in actually investing into these early stage startups?
Look, if it's a direct investment, it really depends on the stage. So the earlier, probably the lower check, because it's a little bit more risk. So we know anywhere from circa 10K individually to up to 25K sort of thing into direct investments. And then from a syndicate point of view, because we're able to aggregate multiple investors into the one investment, we've had prior investments that have generated about 100K or more individual investments into a fundraise. And you got to remember that a syndicate is not going to be a one like a silver bullet to your fundraise. It's going to complement the other strategies that you use. So whether it's generating fundraising through a syndicate to show momentum in fundraising, to show interest from investors, get that momentum, get that FOMO going from other investors, it's going to be a complement to some of the other strategies you do. And other people look at other funding opportunities like venture debt versus venture equity. They look at any sort of other financing that they could do. They look at the syndicates, and if you look at it as a stack of stuff, it all stacks up and then delivers the overall outcome. And that's part of the stuff that I try and work with founders with. Joanna tries to work with founders with to help them understand that it's not always going to be a one-size approach to everything. Sometimes you might even think, right, well, I'm going to make up a number. I need 100 grand to actually develop this thing. Well, actually, do you? Because maybe have a chat to Sam at Hyper, and maybe they can develop the thing that you need without investing money or partial funds, and you give up sweat equity because you're going to give up equity anyway for the money. The question is, what do you need it for? And if it's to hire people and this and that, great, cool, you need the cash. But maybe if it's for development, you think of alternative ways to kind of get around that problem.
Yeah. No, that's great advice. With that, how do you find in terms of time frame from, say, first reach out to actually money is invested in the bank account and the variance that you see in that time frame?
Oh, look, even we have a variance. We try and be quick, but with a lot of our stuff, especially if we end up syndicating, it could take a while. So a typical syndicated process will usually take a number of weeks, because you want to spend a few weeks, potentially a couple of months, getting to understand it, doing your due diligence, especially if it's kind of later stage where there's more information to review, and then putting it out there for syndicate members to read about it, ask questions about it, attend founder Q&As, and then invest in it. It takes a number of weeks as well. But if it's a direct investment, that's a relatively quick experience from us. If we feel that we're confident enough that this is something we want to get behind, because it's early stage, we move pretty quick. So we're talking a couple of weeks.
Yeah, cool. Good question just come in from Zach, one of our fantastic founders here at Hyper, and he's just asked, how long is your typical holding period, and what does an exit typically look like?
Look, the typical holding period for these sort of investments can range from 3 to 7 years on average. That's kind of typical information that's out there. We've had some good success in recently, where we've been able to kind of sell off a portion of our investments to kind of get back the original amount, but keep the upside into the startup. So we haven't had full liquidities, but we've been fortunate enough that we can kind of take the original investments out of it and redeploy that into other founders. Pardon me. But you're looking at this asset class is a multi-year asset class. This is not a quick turnaround liquidity flip like real estate, like shares. This is an illiquid asset class, and so you have to come into it understanding, as an investor, you don't put all your eggs into this asset class because it is generally illiquid.
That's good advice. And I guess that is the benefit. If you are speaking to an angel investor or a family and friend who is just beginning their journey to potentially invest in your startup, that there are ways to if they invest early, the valuation's low. So maybe the next raise, which might be in 12 months, there might be the ability for some of those shares to be bought at a higher rate. And then I guess, the unicorn, which would be, say, like Canva, where we've heard stories of people investing, 50 grand and coming out millionaires with the recent, share sale event. So
missed that one. Yeah,
that would have been nice.
Pressure's on you, Sam, to find the next one.
Yeah, exactly. A really good question here from Lee, and he talks around the reporting regimes of these early stage startups with an angel investor. So I guess what's communication and updates from founders do you typically see or even require?
Yeah, look, it's the better founders, the one that kind of succeed longer and better, are the ones that practice regular updates. So I'm talking monthly. Quarterly is okay as well. That's fine. I appreciate that you're busy, and especially early stage where you're just doing a million things as a founder. But the better ones are doing it monthly. The good ones are doing it quarterly. Anything outside of that, you're really not going to get the attention or the memory of an investor. So when the time comes for you to do another round, or whether you need a bit more extra cash and you need to do an extension of your round later on, and they're going to be going, well, what's going on with your business? Like, I don't know, like, what you've been up to. I don't know if you've been doing well. I don't know if you're doing bad. Like, I'm nervous to give you more money, basically, is the impact of not communicating regularly to investors.
Yeah, I think there'd be a high correlation between founder communication and follow-on checks from those investors, and come hand in hand.
But also think about from an investor point of view, and someone like myself who is willing to step in and help. If I'm getting a regular update from you, so on a monthly basis, on a quarterly basis, to say, hey, this is what we've done, these are the challenges we've had, and this is the ask of investors at the moment, whether it's connect us with this sort of company for a client, or whether it's help us find some more investors, like, I will see that regularly, and I can actually help out with some of that stuff. If I'm not hearing from you, I don't know that you need help. And you've got this really engaged and invested group of people in your business who want to help. So use it, and use those regular updates to kind of ask them what help you need at that point in time.
Yeah. Good question here from Tafara. So around, I guess, the common methods that you're seeing a raise happen. So whether it's through a SAFE or a direct investment, what's typically coming across your desk at this very early stage?
Oh, look, we're seeing more and more safes, that's for sure, and that's okay. That's not an issue. And so there's certain mechanisms that we can include in a safe to make us investors a little bit more comfortable with it. But generally, safes are more founder friendly than investor friendly. Preference is always for priced equity rounds, because then you get a direct investment into the business. The challenge, I understand from a founder's perspective, is sometimes you need to use a safe because you're not quite sure yet what the business is worth. And you're not able to actually put a valuation on the priced equity. So you kind of go, right, well, I'm going to give you a discount on the future raise that we do at whatever the discount is, and there's going to be a cap on the potential valuation to give you some surety. I would typically look to include certain provisions that are standard for me, such as a maturity date on the safe, where it's going to convert after a certain amount of time at the valuation cap. I would typically look at including a most favored nations clause, which, for those that don't know what that is, it's basically saying, if I invest today under a safe, but as you're doing more safes later on in the same round, you give someone better terms than me, I get to match those better terms. So I'm not held at a disadvantage to someone who invests later, because I get in early. And certain information rights and things like that. But there are certain things that we can do to protect ourselves. But certainly from a founder's point of view, from an investor's perspective, priced equity is always better, because you get direct investment into the business from day dot. And that's why we invest. We want to back you. We've made that decision that we're going to invest in you. From an investor, a priced equity is always best. I'm not seeing any convertible notes being used at the moment, so it's effectively a debt for founders, which is fine, because philosophically I'm not sure if I am aligned with convertible notes. But generally safes, that's kind of the flavor at the moment.
Now, this next question, I've got an answer here, but I'm keen to hear yours, Vadim. So John has asked around the exit environment, I guess the last few years. Have you found it challenging from what you've seen? And if so, how do you handle it, or have you not?
There is data available that shows that in, I think it's either APAC or Australia, we haven't had any IPOs in the last, I want to say 3-4 years. I could be wrong, but look, the bottom line is Australia, we don't really do much IPO exits. So a lot of the exits that come out in our markets are either through secondaries, someone's selling off their shares to someone else before there's a round, or liquidity rounds where you sell off a little bit of your shares as part of the future round of a founder. But more often than not, you see M&A sort of acquisition type buyouts where you find that liquidity in our market. As you look at the kind of maturity and the phases of where startups kind of go from pre-seed all the way to seed, Series A, etc., there's going to be multiple rounds within those things. And why a particular founder will do a round will be very unique to them. Sometimes you will be able to sell off a bit of shares as an investor. Sometimes you won't, because they need all of that money into their business for whatever reason. So it's always different, but my key message out of all that is don't think you're going to raise an IPO, especially from an investor's perspective. We don't expect that to happen in the local market.
It's really good advice. And I'd just touch on that as well, that we've actually seen with the likes of, I did a webinar and interview with Andrew Gazdecki from acquire.com. So these, sales that are actually happening from an acquisition point of view from larger businesses within the ecosystem that want to potentially add that startup to their portfolio or suite of products, we're seeing happening. Maybe it's a large bricks and mortar business that, wants to get into the tech industry and decides, cool, let's acquire a company. So these are traditionally starting to happen a lot more than have in the past as well. So the dynamic of exit is different, but certainly we're seeing it open up.
Yeah, I like that. That makes sense.
Which is cool. Diego has a question. Diego, good to see you from Swazy. So g'day, mate. In the pre-revenue stages, with all the things considered, what is typically an agreeable amount of equity to release relative to the investment that's done early on? So I guess what I'm trying to decipher from that question, and I might be wrong, is what valuations are you typically seeing at, let's just say, a pre-seed range, and what typical type of investments happening relative to that investment?
Yeah, look, Diego, if you're after a number, I'm going to disappoint you. It's impossible to give you a number at that stage. It really depends on what's the market that you're trying to break into, how big is it, and what's the potential upside that we genuinely believe you can achieve, and how quickly. So, general rule of thumb, you kind of look at percentages of equity that you give up across the different stages. So if you're looking at sort of pre-seed/seed, I think the industry norm is, and again, hit me up afterwards. I can find you the stuff about it, the information about it. But you're looking at giving up circa 17.5% of your equity at that first sort of raise. And then you want to leave enough equity for the founders, for future investors and VCs, because what they're going to be looking for is to say, look, have you given up too much of your business up front to demotivate you to actually do this long term, because you just haven't got enough left of it for yourself. So general rule of thumb, in my mind, I just remember the stats: 17.5% of your business should be given up at the first stage. Now, that then depends on what do you value the business, how big is the market, what are your competitors valuing themselves at, how much did they raise? Like, there's all these different dynamics. That's why I can't give you a number like $1 million or whatever, because there's just all these variables. But as a percentage of how much of your business you give up, that's around that 17.5%. Maybe even push it to 20% if but that's kind of where it's at.
Yeah, and we find, just to help with answering that as well, is the valuation is really dependable on, as well, early on, that demonstratable traction. So there's a few different valuation methods that our startup advisory team will use, and the more that we can get more validation, more traction, more early signs of, I guess, success into the market, means we can push that valuation up a bit more as well.
Yeah, exactly.
And
so
investors will understand that.
Yeah, showing traction and run rate can certainly help with multiples and all that sort of stuff.
Yeah, that's great. So we've had we're just on about time, Vadim, and we've got some a whole bunch of more questions there. But I'm going to share a QR code post this chat for you to be able to guest listening in, scan, and chat to one of our startup advisory team to help you with answering any of those questions and booking a free call. This recording will be shared as well. And Vadim, what's the best way for anyone to get in contact with you as well?
Oh, look, I'm always loitering and doing stuff on LinkedIn, so definitely hit me up on LinkedIn. Through that, there's a contact information on there against the profile, but also have a look at Blossom Capital Partners on the Aussie Angels platform if you want to get involved and contact us. And so that's more for investors, but also if you want to pitch to have your deal syndicated. Otherwise, it's Vadim at blossomcapitalpartners.com.au.
Fantastic. And Vadim, any further parting advice? I like to ask this question at the end of any of these webinars for someone that is at an idea stage and looking for funding.
Get out there and ask for advice.
Awesome.
Whether it's people like me who just give their 2 cents, every little bit of advice will help. And who knows, maybe through that process, I'll even lean in and say, actually, I like what you're doing. Let me connect you in with people, or even let me get involved and back you myself. So get out there. Don't be afraid to kind of put it out there. We as investors, we do not care about the novelty of it. We're looking at it from an investment point of view. So don't be afraid to tell people about it, especially
Fantastic.
investors.
And for anyone or any of our founders who want to get in touch with Vadim and just want to understand his investment mandate even further, feel free to reach out to me directly for an introduction.
Thanks, Sam.
Awesome. Thanks, Vadim. Thanks everyone for tuning in. Appreciate it, and enjoy the rest of your day.